to talk about the fundamental side of things, we'd like to call on our very own VP for Research and also the President of the CFA Society, Ms. April Tan.
Good morning, everyone. Okay, it's good to see so many people attending our market briefing this early on a Saturday morning. So anyway, I'll be talking about our market outlook based on fundamentals. Okay, so earlier this year, we talked about the PSEI hitting 10,000. Actually, this is a message that we've been sharing since 2012. And we are maintaining our view that the market is well on its way to hit 10,000. It's still on track. But the pace will slow down in the short term, and this is due to numerous speed bumps. So this is what we will be talking about. Why are we still bullish? What are the speed bumps? But then again, even with those issues, we believe that there's opportunity to generate returns through stock picking. Okay, so what has happened so far for this year? Okay, the PSEI is now up by only 3.5% after rising by as much as 12.4%. So initially, we had a very good start. What has changed? Okay, the market has pulled back because of numerous reasons. First of all, we had the disappointing first quarter 2015 GDP growth and also first quarter earnings performance by listed companies. Okay, and because of that, of course, the market was sold off. It doesn't help that our peers, our closest peers, which are Thailand and Indonesia, were also sold off. So you can see from the chart there, the green chart is actually, or the green line is the Philippines, which is actually the strongest market. We're up by 3.5% for the year, but Thailand is down 5.4% and Indonesia is down by 8.8%. So globally, how fund managers work is that they will put the Philippines in an investment basket together with Thailand and Indonesia. And if they have to sell off Thailand and Indonesia, they also have to sell off their positions in the Philippines. So we are also affected by that. Next, there's this growing preference for Japanese and Chinese stock markets. So one of the big news right now is, of course, the ongoing sell-off of China. I think China went up by as much as 150% before it was sold down. That is the reason why it's being sold down so sharply, because people made 150% in a span of a year. Okay, and then lastly, of course, we had these concerns of a contagion from a possible Greek default just a few months ago. Okay, so the last two concerns, in my opinion, are no longer there. Of course, China doesn't seem to be as attractive anymore after it's been sold off. And, you know, there seems to be a consensus view right now that the Chinese economy isn't as strong, or the reason why it went up isn't as solid. And next, of course, Greece did not have a default. Nevertheless, the bad news, we believe that other concerns are still here, and the market, because of that, the market will most likely just move sideways. Okay, first of all, one of the bad news is the earnings growth of the PSEI has actually slowed down. So during the start of the year, we were anticipating earnings growth of listed companies to reach 15% for this year. But because of the disappointing first quarter earnings performance and, of course, all the bad news that came in, we're now projecting earnings of listed companies to slow down, or the growth to slow down to around 4%. For next year, we expect growth to pick up, but then again, we are projecting it to go up by 10%, which, I mean, if you think about it, 10% is a moderate growth. It's not a very exciting pace of growth. Okay, so what are the reasons why our growth outlook has slowed down? First, the banks are reporting flat net interest margins. Okay, initially, we thought that banks would be able to increase the lending rates already okay, such that they would have faster earnings growth. But based on what we've seen during the first quarter, this is not happening. Okay, second, for the gaming sector, of course, before the casino started to operate, we had a very optimistic outlook for the operations. Unfortunately, these did not materialize, and the operations were also delayed, leading to a slower than expected pickup. For the consumers, the consumer sector, this is one of the most disappointing sectors. The first quarter earnings were below expected. Earlier on, we thought that we would see a positive surprise from the consumers because of the windfall gains that we would get from lower oil prices, but it did not materialize. And based on our talks with corporates, consumer companies are facing more intense competition. And finally, for the power sector, a lot of the companies disclosed delays in operations. So because of these reasons, we have actually reduced our end 2015 target to 7,950. Earlier this year, we said our target was 8,300. And then earlier on, we talked about Thailand and Indonesia being sold off. We believe that the problems there are actually more enduring. Okay, just to go through them, Indonesia is suffering from weak exports. They're also suffering from high inflation and interest rates, and the government spending is disappointing. For Thailand, they're suffering from weak exports. Investment growth is being hampered by low capacity utilization, and consumers there are being hurt by high debt levels and tight credit conditions. So that's the reason why these markets continue to deteriorate, and that would act a drag to the Philippine market as well. Okay, and then now a new concern. Of course, we hear about this all the time now. The Fed is expected to start raising rates soon. So we just got the consensus forecast for interest rates. So as you can see right now, from a 0.25%, the interest rates in the US are expected to go up by around 25 basis points come September, another 25 basis points by December. And I think the consensus is expecting this to be increasing in 2016. Okay, and I guess the concern is for you guys who have been investing in the stock market for a bit, will we see a repeat of May 2013 when we had the taper tantrums? So I remember from 7.4, the PSEI dropped to around 5.8. So I guess there is this concern that we might see a repeat of the taper tantrum. But that's the bad news. The good news is we believe that the weakness is only temporary. Okay. The long-term outlook for the stock market remains attractive, so we'll discuss this one by one. First of all, we still have one of the best fundamental long-term stories globally. Next, we believe that liquidity conditions remain favorable for stocks, or given the liquidity conditions, stocks will remain the asset of choice. And third, while we talked about Greece not being a problem, I know that if you watch the news, they always say that this is only delaying the problem. Okay, I'd like to talk about why it will not be that much of a problem going forward, even though they haven't really solved the problem. And finally, I'd like to say with a conviction that we are not entering a bear market. We're not in a distribution phase. And I'll discuss this in more detail later. Okay, as far as the Philippine economy is concerned, we're actually one of the fastest growing economies in the world. So this is based on the GDP growth forecast of the World Bank. So the World Bank is projecting the economy to grow by 6.5%. Yes, the government's projection of 7% might not be hit, but the 6.5% growth is still faster than the global economic growth, the growth of developed economies, as you can see, at only 2%, and that of developing economies. Okay, so 6.5% is actually a very fast growth, and that's one of the reasons why foreign investors are very much attracted to invest in the Philippines. Okay, and then earlier on, we talked about Thailand and Indonesia. So one of the things that I'd like to point out again is that we are different from Thailand and Indonesia in the sense that we are less dependent on exports. Yes, the Philippines export is also weak, but if you look at our dependency on exports, our dependency is only around 22% of the GDP. As you can see, Thailand, one of the reasons why they're being hurt by the weak exports is because their dependency is more than 70%. On the other hand, while Indonesia's dependency is similar to the Philippines, you can see that a big chunk of their exports is actually mining and petroleum products. And of course, you know that mineral prices right now are low, oil prices are also low, which is why they're also being hurt. At least the Philippines were not being hurt by that. We are actually benefiting from low oil and mineral prices. Okay, and then another thing, although we are now seeing the peso a little bit weak, we're actually so much better off than Thailand and Indonesia. And one of the reasons why is because of our strong current account position. A current account position is just the measured by the amount of dollars that comes in less the dollars that go back out. So you actually, the ideal scenario is for a country to have more dollars than it needs to pay off. So if you have more dollars, it just means your current account is positive. So current account as a percentage of GDP, ours is 4.4%. As you can see, Indonesia is negative 2.9, which is one of the reasons why their currency is very weak. And one of the reasons why, or two of the reasons why we have a strong current account position is because of the resilience of our OFW remittances. Despite the challenges that we've been facing earlier this year, from the January to May period, our OFW remittances are still up by 5.4%. And the BPO revenues still remain strong. So in 2014, it was up by 18.7%. For the whole of 2015, it's expected to grow by 12.2%. And I'm sure you've read in the papers that soon the BPO sector may overtake OFW remittances in terms of contribution to GDP. So the bottom line is because of our strong current account position, the risk of a sharp rate increase and a significant peso weakness is minimized for the Philippines. And then one of the bad news in earlier this year is the underspending by the government. But I'd just like to point out the reason why the government is underspending is not because it doesn't have money, okay, which is actually a bigger problem. The government has money, it just has problems deploying. As you can see here, budget deficit to GDP, it's only negative 1.1%. And then the debt level is actually going down to the point only 45%. And in fact, it's still expected to go down next year. And earlier on, I was asked whether, we have to wait for a long while to determine whether we should be bullish or, we should remain bearish. I said that there will be advanced indicators to show us whether the economy is already picking up. When we did our research, we actually saw that the government spending, which was a problem in the first quarter, is actually reversing. So the second quarter GDP might actually surprise on the positive side. As you can see here, in the first quarter, government spending was weak because January government spending was down. And then the capital outlays, which is the infrastructure spending, was down by an average of 11% during the first quarter. But then for the month of April, it really is picking up. As you can see, government spending is up 9%. Capital outlay, which is infra spending, is up 40%. For the month of May, it's up by 28.5%. We're quite excited to see the second quarter GDP as we may actually see a positive surprise. Of course, investment spending in the Philippines is still picking up. I remember the first time I talked about investment spending when we started doing our briefing for the customers. Investment spending in the Philippines was only 19% of GDP. Now it's hitting 21.7% of GDP. So slowly but surely it is picking up. And I think one of the benefits that we have is that capacity utilization of the manufacturers is at a very high level of 83%. So earlier on, we talked about Thailand and how getting investments to come in is a problem because capacity utilization is low. Okay, in Thailand, capacity utilization of corporates is 50%. So if corporates are operating at 50% capacity, there is no incentive to invest on more capacity. On the other hand, in the Philippines, the capacity utilization is already very high, so there is an incentive for corporates to actually spend more on expansion. And then, of course, PPPs, I guess we've become jaded already as far as PPPs are concerned. When President Noynoy Aquino administration first started, people were really very excited about this, but it really took them a while to roll out the PPPs. But if you are actually paying attention, PPPs are starting to pick up steam. While only 6.3 billion US dollars worth of projects have been awarded so far, there are 12.1 billion US dollars worth of projects in the bidding stage, and much more, of course, in the procurement stage. So it seems like the process has been streamlined to the point that they can actually launch more PPP projects at a faster pace. We are quite optimistic on this, given that these projects can boost economic growth and increase productivity. Now we can move on to the liquidity conditions. This is a slide that I've shown also in January. Okay, just to recap what's going on in the world. Liquidity conditions globally still remain favorable for stocks. What has changed with the slide today versus January or February is that, if you look at China, the list has actually increased. Since January, okay, China has implemented 3 more steps to loosen liquidity conditions. First, they cut the lending and the deposit rates. They cut it actually 3 times. And the reserve requirement, they cut it once more. So liquidity conditions remain favorable. Now, if you look at the 4 countries, only the US is tightening. That means that there will still be a lot of money. And then as far as the rate hikes are concerned, are we going to see a repeat of 2013? I believe not. And one of the things that I'd like to point out is if you look at June 2013 versus June 2015, we went through the survey of the Fed participants. Okay, so it's the central tendency of long-run economic projection. So after the Fed meeting, the members are given a survey to ask them, what do you think will happen to the U.S. economy? So what do you think is the long-term GDP growth of the U.S.? In June 2013, when the Fed initially talked about tapering of the bond buyback program, they were expecting the U.S. economy to grow by 2.3 to 2.5%. But as of June, they kind of accepted the fact that the U.S. economy cannot grow as fast. So now they're expecting it to 2.3. And in light of that, the Fed fund rate, so in the past, maybe they were expecting a Fed fund rate that would increase much faster, 3.75 to 4.25 on a normalized basis. Of course, it doesn't mean it's going to happen right away, but eventually. Okay, but by June, that expectation has actually gone down quite a bit. So now they expect the long-run interest rate to be 3.5 to 3.75%, so much lower. In light of this, the pace of tightening is expected to be slower. The U.S. is not expected to, when they increase rates, it's not going to be the same pace as the time of Alan Greenspan, where, they just increased it by 25 basis points every meeting. It's going to be slower this time around. So it's not going to be that bad for the market. I think later Mr. Lee will show how a soft tightening is beneficial for the market. And then, of course, Greece, earlier on, we talked about how Greece has not solved all their problems. But I'd like to point out that there is less risk of a contagion from a Greek default or a Portuguese default, Italian, whatever. There is less risk. So if you look at the chart here, you will see the red lines is Greece. And then the other lines are the other periphery economies that have problems, such as Portugal, Italy, Spain. So you will see that in the earlier episode, which was 2011, 2012, the rates of all these countries went up quite significantly as a reflection of the concern of contagion. But if you look at the latest episode where Greece encountered a problem, you will notice that Portugal, Italy, and Spain did not actually increase. And why is that? Well, first of all, bulk of the Greek debts are no longer held by the private investors. So the Greek debts are held by the IMF, the World Bank, the EU, and those institutions. Okay, and next, of course, in 2012, 2011, because of what happened, Europe created the ESM and the OMT, the European Stability Mechanism and the outright monetary transaction. Bottom line is these groups and these mechanisms will allow the European Central Bank to buy the bonds of other European economies if they feel that the interest rates are too high to prevent contagion risk. So in light of that, the risk of interest rates of other European economies and other markets globally going up because of a Greek default is okay. And next, or finally, I'd like to say that I don't think we are about to enter a bear market. So what happens in a bear market? Typically, it's characterized by overexpansion and excessive borrowing. Okay, when I teach economics, this is what I usually say, di ba? In fact, when you attend the COL seminar, when we talk about business cycles, we say we have to see a lot of greed. And greed is manifest by overexpansion and excessive borrowing because you really are very excited. That's why, you borrow because there is this high level of confidence. Okay, then of course, this is manifest in the economy through high inflation and high interest rates. Then of course, what happens is the BSP will try to intervene to prevent bubble economy. And then of course, if interest rates are increased so much or steps are taken to control over economic growth or control the bubble, we will have a recession and a bear market. So I'd just like to say that there are no signs of a bear market. There's no excessive borrowing at this point. Debt levels are not excessive. So if you see our bank debt to GDP is only at 40.5%. Okay, so where are our neighbors? Indonesia, admittedly, it's lower, but Thailand, it's at 97.9%. So malayo pa talaga. And then loans to deposit ratio, meaning the amount of money that banks have lent out, is still very low at 65.9. So the banks have not been lending aggressively yet. Okay. We also looked at the debt levels of COL monitored stocks. Okay. Net debt to equity ratio is only 0.28%. So it's highly manageable. A 0.28% debt to equity is quite low, actually. And banks really have a lot of cash. And then inflation rate. We all know that inflation is very low right now. The headline inflation is at 1.2. Admittedly, this is because oil prices are low. But if we look at core inflation, which strips out the impact of volatile oil prices, it's still very low at 2%. I don't think this is a reflection of excesses or greed if the inflation level is still low. Okay. Okay, and then, of course, although earlier on we talked about a lot of bad news in the different sectors, we believe that not all sectors are facing challenges. So we still have some sectors which have a positive to neutral short-term view, and these would be the airlines, banks, properties, and power. We have a negative outlook on the telcos, mining, consumer sector, and the gaming. So in January of this year, when we first did our presentation for 2015, we still had a positive view on the consumer sector, but we have now shifted it to negative. Okay, the gaming, we had the neutral sector, neutral outlook then. Okay, so why do we have a positive outlook on the airline sector? Of course, demand for travel is picking up. Lower oil prices should boost their margins. I mean, if you're booking your vacation, you will notice that prices have not gone down today versus last year, despite the drop in oil prices. And that should translate to better earnings for airlines. And also, of course, valuations remain attractive. Okay, for the banks, we have a neutral outlook. The negative, obviously, is that they cannot really increase the interest rates or the margins that they are earning. But then again, lending growth remains strong. It's still picking up. And we believe come 2016, EPS growth will also pick up back to 13%. And then for properties, the negative there is that I think it's only sentiment. People are just worried that higher interest rates will lead to weaker demand for properties. But then again, if you think of the property sector over the long term, it should benefit from also, our property companies are not residential property companies only. They usually are mixed. They have offices, malls, and the outlook for offices and malls remain positive. So if you look at the EPS growth, it's still quite strong for 2015 and 2016. And then power sector, in some ways it was quite disappointing because a lot of them disclosed delays. But then for 2016, we are confident that, because of delays, the new capacity will come online in 2016 and allow EPS growth to pick up to around 16%. And of course, over the long term, growing demand for power and the high level of utilization rate for power plants right now will lead to faster growth. Okay, so why do we have a negative view on telcos, mining, gaming, and consumers? Well, first of all, for telcos, cellular revenues are weakening. I'm sure you guys are not doing as much SMS now as before because you're using apps like Viber, WhatsApp, Facebook Messenger, and all of that. And of course, there's this intense competition, the free Facebook promo of Globe versus Smart and all of that. The only positive is that demand for broadband remains strong. Okay, so eventually things should improve. But for 2016, we expect EPS growth to actually go down by 4%. Then for mining, we're negative on this sector because of falling commodity prices, which will hurt revenues and profits of mining companies. What has changed? We are worried of the intense competition. The long-term outlook is still positive. The problem is, because of the intense competition, consumer companies are earning less or not meeting the lofty expectations of people. Because if you think about it, consumer companies right now are trading at 20 plus times, 30 plus times PE versus the market, which is trading at, say, 19, 20 times PE. So they really are more expensive because they're everybody's favorites. So if these consumer companies disappoint, they will be vulnerable to a sell-off. Okay. And then for the gaming sector, again, the concern really is that expectations have been too optimistic and they're not meeting up to these expectations. Okay, and sentiment for the sector is poor because of what's happening right now in China. There's a clampdown of corruption. Okay. Okay, what's our strategy? We believe that you should stay invested, okay, and focus on stock picking. Okay, while the stock market short-term outlook has deteriorated, we believe that you should stay invested because the long-term outlook remains attractive. And despite the sideways outlook for the market, we believe there's an opportunity to generate returns through stock picking. So earlier on, we said that not all sectors, not all companies face an uncertain short-term outlook. Okay, so what type of stock should you focus on? Focus on stocks that have been sold off despite having positive outlook both in the short term and the long term. Okay, so these are our stock picks. First, we still like Cebu Pacific. We like it because it's the market leader for domestic travel. And it will be a major beneficiary of industry consolidation and falling oil prices. For 2015, we're projecting core profits to more than double to 6.5 billion. Okay, valuations are also very attractive. I think it's now trading at 93 pesos. Fair value is 156. So quite a significant upside for the airline company. Metro Bank, well, it's the second largest bank in the country, and it will benefit from the growing demand for loans. Earlier this year, one of the risks that we talked about, or one of the reasons why it was weak, is because of the risk of capital raising. People were avoiding the stock because of this risk, but this is no longer a concern because it already raised 32 billion due to the stock rights offering. And it's trading at only 1.5 times price to book versus BDO, 1.9 times price to book, and BPI 2.4. So a huge discount for similar or one of the top 3 banks. SM Prime, okay, we like SM Prime because it is still predominantly a mall operator. So it will not be affected even with it will not be affected much even if interest rates go up. But we are really not concerned about rising interest rates and demand for residential. So anyway, we think this is the best proxy for consumers at this point, because if you think about it, you know, it's the dominant mall operator, and you know, it can charge the rates it wants on the tenants. Okay. And it's a good proxy for consumer spending in the country. Okay, and despite all these concerns about residential properties being weak, the profitability of its residential business continues to pick up. It's up 6.6% in 2014 and 7% in the first quarter. And I think take-up sales are increasing much stronger. Okay. And then we also like Philinvest Land. Philinvest Land has successfully transitioned from being a pure horizontal property developer focused on the provinces to being a diversified residential developer. So now it has mid-rise, high-rise projects in Manila. Okay, and one of the things that we like about Philinvest is that it is now more focused on rental properties. So it plans to triple its rental income in 5 years, which will boost its recurring cash flow. So in the past, it did not have rental properties, but now the rental properties are growing in size. Okay, profits to grow by a compounded annual growth rate of 13% in the next 5 years. And it's one of the most attractively priced property companies, trading at 8.7 times PE and a 46% discount to NAV. Okay, so our new addition is Ayala Land. Okay, it's one of the most diversified property companies in terms of sources of profits. Again, although Ayala Land is widely known as a residential developer, it's also a mall operator and an office landlord. Okay, and it will triple its investment properties or its leasing properties over the next 7 years. Okay, and it already has 127 billion of unbooked residential revenues, meaning these are already sold. They will just book it over the next 2 to 3 years as people pay their obligations. And of course, it has a lot of land bank in different parts of the country, in attractive locations, which will allow it to continue expanding its portfolio. Okay, Ayala Land has been sold off. I mean, we've always liked Ayala Land, except that it was expensive. The sell-off has made the stock attractive, and we believe it's now would be a good time to start looking at Ayala Land. And then First Gen, we still like First Gen. despite the fact that it has been one of our underperforming picks. Okay, around 90% of its capacity is covered by long-term supply contracts, providing it with stability. Okay, and then of course the expansion or the capacity will expand by around 23%, and recurring profits will increase by 24.2% from 2014 to 2016. Okay, the reason why it was sold off was because 49% owned subsidiary EDC came out with negative earnings guidance. But then again, the negative earnings guidance was just a delay. Okay, the new plant will come online in 2016. Okay, valuations are very compelling. It's trading at 14 times 2016 PE versus 19 times for the market, and 35% upside to the fair value estimate. And then, of course, Ayala Corp. We like Ayala Corp because it's one of the oldest and most diversified holding companies in the country with a reputation of excellence given its investments in market leaders such as BPI, Ayala Land, Globe, Manila Water. Okay, diversification into power infrastructure to help drive long-term growth and increase the defensive sources of income and cash flow. So here is the summary of our stock picks and our buy below prices. So for those that look at our research on a regular basis, we adjusted our buy below prices to 25%. But now we have adjusted it back to around 15% for most stocks because we believe that conditions have improved. When we adjusted it to 25%, we still had the Greek contagion problem, but now that is no longer a problem. So we are now putting it back to 15%. Okay. We also suffered from foreign funds flowing out of Thailand, Indonesia, and Philippines to North Asia, which would be Japan and China, and due to concerns of a possible Greek default. Okay. While the attractiveness of China and the possible Greek default are no longer concerns, the near-term outlook of the stock market remains cautious given challenges facing listed companies. Continuous sell-off of Thai and Indonesian markets, and the upcoming Fed rate hike in the US. Nevertheless, we believe the market's weakness is only temporary. Indicators continue to point to a favorable long-term outlook for the Philippine economy. And the Philippines currently has one of the best fundamental long-term stories globally. Okay. Liquidity conditions also remain favorable for stocks. Okay. And also there are no indications that we are about to enter a bear market. And there's room for stock picking because not all sectors are facing challenges. Okay, given the said factors, investors should stay invested, and there's also an opportunity to generate returns through stock picking. We advise investors to focus on stocks that have been sold off despite having a positive outlook, both in the short term and the long term. So our stock picks are Cebu Pacific, Metrobank, SM Prime, Philinvest, Ayala Land, FGen, and Ayala Corp. Okay, so that ends my presentation. Thank you very much. And before I end, I'd like to mention that we are in social media. We're at Facebook, Twitter, YouTube, and also Instagram. So if you want a faster updates on what our views are on the market, what our stock picks are, please follow us and like us. And I'm also on Twitter, and sometimes we also share our stock picks. Okay, thank you very much.